Hello and welcome to this lecture on the goal of the farm. And this is paramount to know why do farms exist in the first place. And when we talk about the farm, we are talking about every organization, starting from a sole proprietorship owned by one person, to a partnership, to a large company like Safaricom and the others. So what is the goal of these farms? Why do they exist? Whom do they serve? That is why we are, like I said, it is very, very important. It is very core to corporate finance to know why farms exist. And it is important to define why a farm exists because of three reasons. What should farms try to maximize? Remember from your linear programming, you are doing your maximization or minimization. So for a farm, what should a farm try to maximize? And the answer to that question is the one that gives us answers to certain questions. For example, where to invest in, what project should we undertake, in other words. Where should we get our finance from? Money, the capital. And lastly, how do we share out the profits after the company has done its own projects? How does it pay back the shareholders? So that is why it is very, very important to define the goal, because the goal of the farm is the one that informs these three decisions: where to invest, how to finance the investment, and how to pay back the capital to the shareholders. Now, the goal of the farm has evolved through several viewpoints. In the early industrial era, that was long ago, profit maximization was the sole objective of the farm. And like we are going to see, profit maximization, while good, has its own shortcomings. In the mid 20th century, the goal of the farm was to satisfy the needs of the managers, the management, which of course you can see has its own shortcomings because the managers are just employees of the farm. They may not necessarily be the people financing that project. Currently, where we are, the goal of the farm is to maximize the wealth of the shareholders, shareholder wealth maximization. And this is a better objective than profit maximization, but like we are going to see also, it ignores certain people who may not be shareholders. Think of shareholders as the owners, but there are people out there who are also affected by the decision of the farm but are not necessarily shareholders. Think of when you open a factory somewhere in the neighborhood. Of course, the shareholders will make money, but it is also going to affect the surrounding environment. Probably there's pollution, probably there's noise, there are people who are employed. So like you can see, the farm affects people beyond the shareholders. And where we are moving into is to what we call stakeholder capitalism and ESG. ESG means environmental, social, and governance. So beyond maximizing the shareholder wealth, the company should also care about the environment. Like I told you, some companies will pollute the environment. So of what use is it to make a lot of money while polluting the environment? You should also try and do some social justice, display some social justice. I'm sure you people have seen Safaricom and other companies come to your neighborhood. They build a school here, across there. So beyond giving shareholders money, they are also contributing to the society. And governance, how is the company itself run? Is it ethical? Does it display good ethical conduct? So this is where we are moving to, and it is a very big movement now So we are moving beyond simply the shareholders to look at a company as affecting people beyond the shareholders. But where we are under shareholder wealth maximization. So we have already looked at this, why it is important to define the goal of the firm, because it informs investment decisions. And why is that? So a manager must choose a project that increases the firm value. And like we are going to see later in the course, this example applies a lot. If a project is earning 15% when the cost of capital is 10%, it creates 5% of net economic value per unit of currency invested. So another example, you can't borrow money at say 20% and invest in a project that is giving you 10%. So that way you are losing money. So you must always invest in a project that gives you a return higher than the cost of capital. Financing decisions is also another one that we are talking about. The managers must determine the optimal capital structure, the right mix of debt and equity that minimizes the cost of capital and maximizes firm value. So again, this is a topic that we are going to cover. And lastly, we have dividend decisions. How much money do you distribute to the investors after the end of the year? Once you declare your profits, how much money do you pay to the investors? So that's very, very important. So let's look at the early goals. One of the early goals of the firm was profit maximization. And like we know from our accounting, profit is revenue minus cost. Revenue minus the expenses. You know how to do an income statement. And from your microeconomics, you also saw when do we maximize profits? You maximize profits when marginal revenue is equals to marginal cost. So those are two perspectives that you should have covered in the past in accounting and in economics. So this is the mathematical representation. I'm not going to go a lot into that. We are going to look at the advantages of profit maximization. It is a simple and intuitive concept. It is easy to understand. It is easy to tell people, in this project we are investing 10,000 shillings, the cost will be 8,000, we are going to get a profit of 2,000. Very simple. And it is also aligned with market incentives. So people get attracted to the idea of making money. So if you tell people this is the cost, this is the revenue you expect, it is easy to convince somebody to join or to finance your project. And it is easy to measure, very easily measurable. You can measure the profit easily. It's quite straightforward. However, it has its own shortcomings. Number one, it ignores the time value of money. This is a topic that we are going to cover later on. In other words, the sharing today is worth more than a sharing tomorrow. But profit maximization treats a sharing today as the equivalent of a sharing tomorrow. It ignores risks. So for example, if you have two projects, both projects have a revenue of 10,000. Both projects have a cost of 8,000, which means both projects have a profit of 2,000, but they have different risk profiles. One project is very likely to fail, another one is very likely to succeed. So the two projects will be treated as if they are one and the same, they are equivalent, which is not true. Number three, accounting distortions. You know, profit can be distorted through accounting manipulation. The provision for bad debts, disposal of assets, all those things, depreciation, all those things arise out of accounting policies. So one company could be having a very different way of depreciating its assets, which would impact on profits. Another one that is not listed here is that when you're talking about profit maximization, you are only thinking about yourself. And like I mentioned, supposing you have a nice project here in your neighborhood, making you a lot of money, but that is polluting the environment. Everybody around your area is sick. How do you treat that? How do you go to sleep knowing very well that everybody in the neighborhood is sick because of your project that is giving you a lot of money? So, and even people like employees, how do you treat your employees? You see, when you're just talking about making profits, you really don't care about your employees. They could be dying of overwork, of being poisoned by the fumes in that factory of yours. So it ignores any other person outside the people making money. So that is a very, very important component. It may not be listed here. So these are the details that we have here. We're going to go up, 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 up. Then we look at the second one. The second objective is wealth maximization. The idea of wealth maximization goes beyond profit. It looks at the market value of equity and the market value of debt. So, for a company that is listed, the wealth maximization can be approximated by maximizing the stock value, the stock market value, the stock price. So, in other words, when you are running your farm, you should maximize the prices of stock. Think of a company like Safaricom that is listed at the Nairobi Securities Exchange. So when you are running that company, you should aim to maximize the price of the shares of Safaricom at the stock exchange. That one goes beyond simply making profits. So, and stock prices are important because they take into account the time value of money. They take into account risk, which is the rate of return, and future expectations. It also looks at the company. Think of it this way. You have a company that is doing very well now, making a lot of money, but it is only going to make money for the next 2 months. Think of another company that is not making a lot of money, but it is going to continue operating for the next 10 or 20 years. Which one is better? So the idea of wealth maximization looks, takes into account the future expectations of the company. So very, very, very important. So we are going to look at the net present value. This is a topic of on its own. So a lot of the things we are discussing here, we are going to look at them later on. And for now, we just want to look at the three objectives of the firm: profit maximization versus wealth maximization. So these are the key differences at a glance. Profit maximization is based on accounting profit. Wealth maximization is based on market value. Profit maximization ignores time value of money. Wealth maximization incorporates time value of money. Profit maximization ignores risks, but wealth maximization does not ignore risk. Profit maximization simply aims to maximize profits. Wealth maximization maximizes what we call the net present value. While profit maximization is short-term, wealth maximization is long-term. So I just want to skip this because a few of these things will come together once we finish the whole course. They are going to come up. The idea of agency conflicts is covered in the next chapter, and we are going to see how this works out. What is arising now is the idea of ESG, environmental, social, and governance. The idea that a company serves more than just the shareholders. We have the environment. You need to take care of the environment, however much you are making money. You have to take care of the community around you, and governance. And one of the issues that is coming up currently is the idea of climate change. Climate change is very, very central, and companies nowadays have to really factor in how much are they contributing to climate change. That is why you can see even at Karatina University nowadays, there's a lot of insistence on using solar energy as opposed to using electricity. So the company is simply moving beyond thinking about students and staff only. So they are thinking about the environment, and sustainability matters. So even consumers, they expect you to show a sense of responsibility, not just making money. So consumers, so imagine you have a company that you know exploits its workers so much. Would you buy goods from that company? So that is why we are talking about the issue of ESG. So moving beyond wealth maximization and profit maximization. So we are looking at stakeholders now.